Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Steve Lively, US Head of iShares Fixed Income ETFs at BlackRock. And we know that BlackRock is the world's largest asset manager with a portfolio exceeding $9.5 trillion. They offer 397 ETFs listed in the US, which includes 111 fixed income ETFs, both active and index tracking ETFs. So we'll talk about fixed income markets, which are very challenging lately. We'll talk about the outlook, trends in the market, and whether there are any areas of opportunities for investors. Steve, welcome. Great to have you on the show.
Thanks for having me, Neena.
So I wanted to start with the recent report that I saw, and BlackRock forecast that assets in fixed income ETFs will grow from about 1.7 trillion today to 5 trillion by the end of this decade. So could you talk about the trends that would drive further adoption of bond ETFs? What would drive this very, very impressive growth that you're projecting?
Yeah, thanks, Neena. This growth, has really been evolving over time, but has accelerated quite a lot in the last few years. And in particular, we've seen an acceleration following, the 2020 market volatility caused by the pandemic. But the four trends we identify in the paper are bond ETFs serving as building blocks in what we call evolved 60-40 portfolios, and we could talk a little bit more about that as we go through this. Active tools, so using bond ETFs as tools for active management. So I think, a lot of times people will fall into this dichotomy of active versus passive. We don't really see that at all. We see the two not only working together, but we also see bond ETFs, index bond ETFs, serving as active management tools. The third trend would be catalysts for modernizing the bond markets, and this is something that's really taken off in the last few years. Bond ETFs, in our view, have actually helped to modernize the bond markets. They've helped the transparency and the liquidity of the over-the-counter bond markets, and I think that's a bit in contrast to what people were worried about a number of years ago when the products first started gaining prominence. And then finally, as the product offerings evolve, we're seeing increasingly precise exposures. So providing more tools for managers to target exposures, to target opportunities and goals for outcomes that investors are seeking. So those are the four broad trends, and we do believe that we will probably hit 2 trillion ahead of schedule. We were expecting that to happen in 2024. We're probably going to see that happen before then, but we do believe we'll hit 5 trillion by 2030 because of these trends.
Very interesting. Now, let's talk about the bond market. First quarter was the worst quarter for US bonds in more than 40 years. And many experts, they started talking about that this decades-long bull market in bonds is coming to an end now with inflation surging and also interest rates on the rise. But we have seen some renewed interest in bonds lately, particularly in government bonds. In fact, the yield on the benchmark 10-year Treasury note, that has been sliding over the past 2-3 weeks, and it had jumped a lot. Earlier this year, it had almost doubled. So lately, the market concerns have shifted from inflation to growth slowdown. And government bonds, we know they tend to perform well during times of slow economic growth. So that is probably one of the reasons why investors are piling into the safety of government debt. So tell us about what lies ahead for bond markets in your view.
Yeah, I think it's interesting. Obviously, we did have a very rough start to the year. And in fact, I think the start of the year was the worst for the bond market on record, to your point. And overall, it's been one of the most challenging markets, Nina, to your point, in decades. So I do think we're seeing a bit of a pivot here. Um, it's too early to tell whether the market is really, finally calming down about inflation. But I would note that the implied break-even inflation, for example, in the 10-year has fallen from over 3% down to approaching 2.5%. So inflation concerns seem to be easing somewhat. There is, of course, a fear of having slower growth and inflation remaining, and I think that's a topic that's currently going through the market. But it does seem like rates are finding somewhat of a landing place here. Now, of course, the Fed could always come out and start making statements that would change that view. But it does feel like we're finding a bit of a resting spot here. And as we've sort of settled into a range, you have started to see substantial flows come back into bond ETFs. And very strangely, you've started to see that, at least for iShares, you've seen that mostly in Treasuries. So we've taken in, well over $20 billion into Treasuries this year. But that's not necessarily surprising. A lot of that was in the short end. We've also seen pretty substantial flows into other high quality exposures like investment grade and municipal. So it fits with the overall theme of concern about both risk off and rising rates. But now, as rates have sort of settled into this range, I think bond investors are looking around and seeing a lot of opportunity, a reset, if you will, since rates have repriced higher. And it's the first time in quite a while that you've had rates at these levels.
Correct. And talking about the Fed, we just saw the minutes from the Fed's meeting, which was held earlier this month. And for the purpose of reference, we're talking in the afternoon of Wednesday, May the 25th. And those minutes suggest that the Fed would raise rates aggressively in the next 2-3 meetings. And probably that would provide them with more flexibility later this year. So with that in mind, do you think that the worst has been priced in by the market? Or what are the biggest market risks currently facing bond investors in your view?
So a couple, and they are a bit in opposition. But one would be that the market is assuming that we finally have hit a turning point in inflation, and we're always just one CPI print away from that view changing. So if we got an unexpectedly large spike in inflation, I think you could rapidly see things change and have a repricing occur to the upside in rates, because it does feel like the market believes that we're hitting some sort of an inflection point here, and maybe things are going to start easing somewhat in terms of inflationary pressures. So that could be proven wrong based on the data. The other risk would be, I think what you alluded to earlier, which is just a view that perhaps a lot of tightening has occurred, not necessarily by hiking the Fed funds rate, but in terms of financial conditions, and that is starting to have an impact on the real economy, and that potentially you could be seeing a slowdown coming. The risk to that would be if the slowdown came faster and was sharper than what even skeptics or pessimists are thinking. So in that case, you would obviously pivot to a risk off mode in terms of credit. And I think we're sort of at this waiting station right now, trying to understand whether we are in fact slowing down, whether inflation is finally easing. So there's a lot to be sorted out here.
Correct. I totally agree with you. There's a lot to be sorted out. So I also wanted to talk about 60-40 portfolio, particularly because many experts who were predicting the death of the bull market and bonds, they also predicted the death of the 60-40 portfolio. So 60-40 portfolio is 60% stocks and 40% bond. So for decades, the 60-40 combination kind of ensured stable growth and steady income for investors. But rising inflation, we know, negatively affects both bonds and stocks. And we saw that during the first quarter, correlations were rising, and both bonds and stocks were getting hammered. So many experts said that probably make it 60-20-20 with 20% all, either in commodities or alls, liquid alls or commodities. So what do you think about 60-40 portfolio? Do investors need to rethink that, make any changes?
Well, I think there's a broader conversation to have about the total portfolio, which is, should your portfolio include not only fixed income and equities, but to your point, should it include commodities and alts? And I do think there's a broader conversation happening around that. The traditional allocation of bonds, however, whether that's 40% or 35 or 45, I do think that there's an enduring place for bonds in the portfolio. And so, yes, the first quarter was punishing to pretty much everything. As real rates go up, that puts pressure on bonds and equities alike, as you pointed out. But I do think over time, there is a place for bonds in the portfolio structurally. And the reason for that is that both from an income generation standpoint, rising rates actually will benefit the income component, because you're going to reprice higher and you're going to start seeing your cash flows go up. Not only that, you're going to be able to reinvest those cash flows at higher rates. So there is, while there's a temporary mark-to-market pain from rising rates, long term, it's helpful to investors from the income and reinvestment standpoint. And the other part of that is that as you do finally reach some sort of stabilization in the level of yields, fixed income then reverts back to its ballast role, which is to say that you're likely to then get negative correlation between bonds and equities, which is the whole point of having a balanced portfolio. And so I do think that, investors, it's very, very hard to time the market, right? So it is tempting to say, well, I think rates are going to go up another X basis points, therefore you should reduce your allocation to fixed income. It's really challenging to get that right. And so what we've been advising investors is to, stay the course, keep a core allocation of fixed income in the portfolio, and then as rates finally, stabilize, look for opportunities to scale into exposures that perhaps they've been shying away from to help augment that.
Right. Timing the market is probably impossible, if not very, very difficult. So you said that bonds should still be a key part of the portfolio, and these negative correlations, they will show over the longer term. So keeping that in mind, where do you see pockets of attractive opportunities in the fixed income markets currently, like short duration bonds or agency mortgages or any other areas?
So the very good news is that a lot of sectors have repriced because of this very sharp and violent backup that we had, in the first quarter. And so I think there are plenty of opportunities. We are starting to see investors move back out the curve in Treasuries, with a view again that perhaps we're reaching some sort of a stabilization here. That remains to be seen, but we are starting to see investors move back out the curve. Both investment grade and high yield spreads have retraced the levels that have not been observed in quite some time. And so especially in high yield, I think a lot of investors are starting to look at that again. That it's become quite attractive relative to recent history. And so as investors start rethinking income generation, you're starting to see them look at high yield. You're starting to see them look at the lower tier of investment grade. Triple B spreads, for example, have widened out a fair amount, and there's some probably some value in investment grade in that tier. And I think municipals have cheapened quite a lot over through this upturn in rates. And so you're seeing a lot of investors start thinking about reallocating to municipals again. So we've seen several $1 billion come into our municipal ETFs this quarter in particular. And so you're starting to see some of these things play out.
Very interesting. So one of the roles that treasuries, treasury bonds in particular, play in a portfolio is useful hedging instruments. Over the decades, investors have used government bonds to safeguard their portfolios. So what kind of fixed income strategies investors can consider to protect their portfolios in the current market environment?
So I think going back to what we were discussing earlier, Nina, was just this idea that it's very hard to time the level of rates. And so I do think, yes, treasuries did not perform that role as rates were rising sharply. And I think that was, due to the Fed making it very clear that they intended to pivot to a much more hawkish path. But I think now that has been priced into the market, I do think you're going to see treasuries resuming that role. And I do think it's important for investors in particular who have an aggressive portfolio, who have a lot of risk assets in the portfolio, to still think about treasuries as ballast in the portfolio or other high grade exposures. But I do think it is important to have something in the portfolio that's going to help balance out those riskier assets. While they're quite attractive from a growth opportunity, you want to at least protect part of the portfolio when you get into a pronounced risk-off environment. And I do think now that we've moved this far, this fast in yields, that it does present that opportunity again.
Right. Now, I also wanted to talk about TIPS ETFs. And we have seen a lot of interest in inflation protection strategies because inflation is one of the biggest concerns for investors over the past few months. Inflation is running at its 4-decade high level. And many investors look at TIPS and TIPS ETFs for protection from inflation, but TIPS also have significant duration risks. So what would you tell investors who want to use these TIPS and TIPS ETFs in their portfolios? Should they use shorter duration TIPS or any other kind of TIP ETFs?
Well, Nina, I think to your point, that is sometimes what surprises investors is that, they see negative price returns in TIPS, even though inflation is accelerating, and it's exactly to your point. It is because TIPS are still fixed income instruments; they still have duration, and so when you see a period that we just saw, when rates are rising and inflation is accelerating, longer duration TIPS are actually still going to see a decline in price, even though investors will ultimately be benefiting from those higher inflation accruals. Now, what we have seen in our flow patterns has been a pivot to shorter dated TIPS. So we have a broad inflation product called TIP. That's sort of the broad market benchmark. It's the workhorse, if you will, for that market. But we also have a shorter duration product called STIP. That's a 0 to 5 fund. And we started to see a lot more flows into that product, and very simply because it is shorter duration. So an investor will capture those inflation accruals, but reduce the amount of duration and therefore the amount of risk to further increases in rates. And that's assuming, of course, that the entire yield curve is more or less moving the same.
Right. STIP is a very interesting product in the current market environment. And you talked a little bit about the role of bonds for the purpose of income generation in a portfolio. And you also mentioned that because rates are rising, so those coupons are going to rise. And so that is another reason why investors could look at bond ETFs in the current rising rate environment. Could you talk about some investment ideas for income-focused investors, because that is one big concern for investors. We have seen a lot of interest in dividend paying stocks in the current environment, because if investors are worried about bonds in the rising rate environments, they are pivoting to dividend paying stocks. So are there any investment ideas for income focused investors that can do well and at the same time provide those steady income to investors?
So, Nina, nothing is for free. So in order to get that income, you're going to take some risk. And I think, the obvious answer in fixed income would be high yield. So just the ability to take advantage of this widening in spreads and this increase in Treasury rates. High yield is, looking fairly attractive relative to where it's been. In the past couple of years, but someone who allocates to high yield also has to have a view that the economy will not tip into a sharp recession, which would cause pressure on companies and cause an increase in defaults and the like. So, I do think you have to approach this with a starting view on where you think the economy is going to go. And if you can get comfortable with a view that the economy may slow down, but may not necessarily tip into a recession, or for that matter, a sharper recession, then that could look quite attractive. As I mentioned before, the same idea with the lower tiers of investment grade, are offering better income than they have, in quite some time. So, and for the tax-aware investor, municipals have cheapened up quite a lot as well. So I think all of these things are now at levels that they haven't been in quite some time. And so depending on an investor's risk tolerance, their outlook, there are places where you could start allocating for income at levels that we just haven't seen for a while, that is.
Right. Could you also talk about some implementation ideas, some ETFs from your suite that investors could use for these ideas?
Sure. So in high yield, we have, our sort of bellwether, our large liquid fund, HYG. That product that was one of the original bond ETFs that we launched in the earlier years. We launched in 2007, but we also have a different version which is broader and captures a wider swath of the market called USHY. So we tend to see investors allocating to both of those funds. They use HYG more as a liquidity sleeve, and they use USHY as a longer-term broad holding. Within investment grade, we have quite a few options. So for just broad exposure, you have, of course, LQD, again, one of the original ETFs that were launched in 2002. So LQD is hitting its 20th anniversary, which is exciting. But you also have a broad product called USIG. And if you want to get a little more targeted, I did mention triple Bs. We have a product called LQDB, which targets that triple B portion of the market. So you can modulate also by duration. We have shorter duration versions of LQD called SLQD, and we have a shorter duration broad product called IGSB. So you can modulate between duration and credit quality within these suites. And then for municipals, we have MUB, and a shorter duration version of that is SUB.
That's very helpful. Now, switching gears a little bit, I also wanted to talk about the benefits of using bond ETFs versus individual bonds. And you alluded to this at the beginning of the show. So could you explain to investors how using bond ETFs benefits them more?
Sure, Nina. I think that's an important theme that's really starting to accelerate both with advisors and individual investors, as well as institutional investors, including active managers, insurance companies, pensions, et cetera. Put simply, bond ETFs provide both diversification and the ability to scale very, very rapidly. So if you think about what you're actually accomplishing with a bond ETF, you're able to buy or sell hundreds or even thousands of bonds instantaneously on exchange. And if you were to describe that to somebody, say, 20 years ago, it would have actually been quite hard to imagine that. But that's where we are. That's what bond ETFs allow you to do. So, importantly, diversification. So individual bonds, one, they're hard to scale at the sort of individual investor level. Bond ETFs level the playing field. And so individual investors can get access to hundreds or thousands of bonds, much the same way that, a larger institutional investor could. So that's very important. Number two, the liquidity, the ability to, upsize or downsize these exposures very efficiently on exchange is incredibly important, especially when you have stressed markets. And then I would say transparency is also quite important. I think now, if we look at the market today compared to where it was, 10 years ago, I think we almost take for granted the amount of transparency that exists. And a lot of that has been created by bond ETFs. So you're seeing transparency in pricing in credit that even, 4 or 5 years ago didn't exist. And a lot of that has been caused by bond ETFs. And so I think that's been important. And then the final point is just from the portfolio construction angle, it's much more efficient to use a bond ETF to construct bond portfolios alongside of individual bonds. They both play a role, but rather than just using individual bonds alone. Now, I'll give you an example. So if you're an active manager and if you look across a lot of large, successful, actively managed funds, you could see, potentially thousands of bonds in those portfolios. But when you have thousands of bonds, in reality, what you ultimately have are, a fair amount of beta exposures, a lot of structural long-term tilts. And, frankly, some of that could be efficiently replaced with bond ETFs, which would then free that manager up to focus on the higher conviction part of their portfolio. So going forward, I think what we're going to see bond ETFs playing a more permanent role in fixed income portfolios, not just as a liquidity tool, but also as a permanent tool to access some of these betas and tilts and factors.
Excellent points and very helpful. That's all we have time for today. Steve, thank you so much for joining us. Really enjoyed the conversation.
Thank you very much, Nina.
So that was Steve Lively, US head of iShares fixed income ETFs. Let's quickly recap ETF tickers that we discussed. STIP was the short-term TIP ETF. MUB was the Muni Bond ETF. LQD for investment-grade corporate bonds. And there are two more ETFs that we discussed. LQDB for triple B-rated corporate bonds. And SLQD for short-term investment grade corporate bonds if you are worried about duration risk. And for high yield corporate debt, we talked about HYG, USHY, and USIG. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Also, make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.